Hello and welcome to the podcast hosted by myself, Louis Kessinger, and my dad, Tommy. We are a part of the Kessinger Lee Group at Baird and have been serving investors in our area for 4 generations. Our goal is to start a conversation around topics within the world of finance and to educate you, our listeners. All right, welcome back to another episode of Father-Son Finance. This episode is actually a little bit of a callback to the very first episode we did, which was on saving versus investing and how they're incredibly different. And this one is going to be investing versus trading. And we're also going to talk about saving a little bit because the three are really intertwined, but all very separate. So let's go ahead and dive right into it and kind of define the two, investing and trading.
2, 3. I'm gonna
go ahead.
So just as Louis said, to call back, our original podcast we ever did was saving versus investing.
Yeah.
And we'd tell you to go look it up, but we have no idea what platform that lives on.
It's in the ether.
It's out there somewhere. But so this is an attempt to give you a little bit of that history in case you saw it or heard it.
Yeah.
And maybe it's out there and you can find it. But saving is the act of putting money in to an account.
Yep.
And the thing about saving that is very different is when you put in X, X never goes low.
Yep.
X never goes down. X goes up
Yep.
by the rate of interest that you received. Or if you are not receiving interest, let's say you're saving in your checking account, which typically don't pay any interest, doesn't pay any interest. That's okay. You're still not going to go lower.
Or you're saving in a coffee can.
Or you're putting it under your mattress, burying it in the yard. It doesn't matter. The amount of money you put into, quote, savings is always there.
Yep.
Now, we can talk about purchasing power and all those things, but I'm just talking about the act of saving your money is dramatically different from investing, because investing is about how much you're willing to let the investment, your original investment, go down before it goes up, or watching your investment go up, and then the emotional roller coaster of it going down before it goes up again. So saving and investing, people use those as interchange. Oh, I save in my 401k. Well, if you're in the S&P 500 index fund in your 401k, you're investing. If you're in the stable value or money market fund in your 401k, you're saving.
Yeah.
So just wanted to try to give those two concepts before we introduce the trading piece of the world.
Well, and trading, I feel like a lot of people, especially in today's world of zero commission brokers like Robinhood and E-Trade, and
not giving commercials, just
these are just ones. Things
not
that are
endorsing
out there. Them. These are tools that are out there for investors in today's public markets.
And the other thing that's kind of interesting about those is, unlike decades ago where you had to buy full shares, you can now buy fractional shares. You can buy $100 worth of something that costs, if a share of Apple is $200 a share and you only have $100 to invest, you can buy one half of one share on some of those platforms. And so it gives you an opportunity to move and invest or trade within those platforms.
Right. And you can do that the same day that you sign up for an account, and you don't have to call somebody on the phone or go meet in an office.
Right.
Like, this is very accessible.
Maybe too accessible.
More accessible than it's ever been, that's for sure. And so, because you can, say on Robinhood, you can have a high yield savings account and a money market fund, so you can have saving.
Right.
You can have an IRA, so you can have investing with the S&P 500 index fund, and you can also buy zero dated options and do trading.
Yeah.
And that's all three in one platform. And so that is why we're trying to clarify, hey, these are three very different things.
Super different. Yeah. Again, not endorsing any of these online platforms, one versus the other. Just trying to give you an example of what is out there. So, investing. Here's where our group defines investing. It involves putting money into financial assets or financial indexes with the expectation of generating returns over a long period of time.
How long?
Well, we define it as a market cycle, a minimum of 5 years.
Yeah.
I mean, I think the best investment time horizon is forever.
Yeah.
I mean, there's money that when I was 23 years old, I came into the business. I put money in my 401k. It is 32 years later. That money is still in my 401k.
Yeah.
So that's forever. And so that's how we define investing: buying shares of a great company or a broad index, depending upon
your options,
where you are, your risk tolerance, what you can handle, whatever. That's a totally different subject. And holding on to it through all the crazy headlines that are always going to happen.
Yep.
Trading, Lou.
Trading is a completely different beast. So trading involves buying and selling financial assets frequently.
Right.
Notice there's no more long-term perspective here. Frequently to profit from short-term price movements. That is what we see trading as. And so an example would be, okay, Tesla reports earnings today, and they've been down this week. They're down 10% this week. These are not real numbers, but just an example. Tesla's down 10% this week. They report earnings. I think that they will have sold more cars in this last quarter, and because I think they will have sold more cars, I think their price is going to go up somewhere between 5 and 10%. So if I buy Tesla before the market closes today, I can sell it tomorrow when the market opens, and I can make 5 or 10%. And that is a trade, and that is trading.
Yes. The other thing that defines trading, a lot of to be clear, we are not traders. So we are giving you examples of trading from things we've read, life experiences that we've seen others do, books we've read.
This is not what we do.
This is not what we do. But so trading, a lot of traders will say, hey, I'm going to trade daily, and I'm going to be liquid at the end of every day. So they're literally putting on those trades like you're talking about in the morning, and they're closing out what's called their book. They're closing out their position at the end of each trading day, or some do a week, or some do a month. They may be thematic. They'll try to trade a trend.
Or they only trade during earnings season.
They only trade during earnings season. And they will use, so let's keep going in here. So trading, the time horizons, literally minutes, hours, days, weeks. That's what they're doing. They're trying to capture the movement, the price movement of a stock. And really what traders love is movement. They love what's called volatility. You'll hear, I love the vol. I love the vol. I hate the vol, for the record.
I hate the vol.
But they'll use technical analysis, which means they're looking at charts. So they're looking at all these graphs of how prices have moved. They'll look at trends, like the old saying, the trend is my friend. Things are going up, let's trade it up. Things are going down, let's trade it down.
Buy the rumor, sell the news.
Buy the rumor, sell the news. Price patterns in that. A trader might use something called the RSI, the Relative Strength Index, which just shows literally the volume of shares, meaning if you think of a herd, so is the herd buying or is the herd selling? I can look at all that data in there. And so there's different risks and reward to that.
And so trading and investing in that way are almost exactly opposite, right? And so you said traders love the volatility. Traders might trade on a news headline or on a hunch, or maybe they are following, numbers and chart patterns, however that is. Long-term investing, what's the hardest part of long-term investing? Not listening to any of that.
Right.
Because it's on every day. It's on your phone. It's on your computer. It's in the break room over a conversation. It's at the dinner table. It's on the news. It's everywhere. And if your time horizon is 5 years, 10, 30, 50, your entire life, then it really doesn't matter what today's headline is from a investment total return standpoint. Your portfolio value may change that day. And actually it will change every day if you're an investor. But if your time horizon is long, and it needs to be if you're going to be an investor, then that is the hard part, is to look past that. Whereas a trader is looking for that.
So let's give some numbers. So basically, these are from Bloomberg, S&P. You can pull these up almost anywhere. So I'm going to be directionally accurate, maybe not numerically accurate, but every day that the market is open, it's about a 50-50 chance that it's going to be higher or lower.
Yep,
so
coin flip.
It's totally a coin flip in that regard. So that's daily. And then you go to annually. So each year, we know over the last 100 years, statistically speaking, that your investment in, say, an index, I'm just using the S&P 500 here, over that time period, 70% of those years, you're going to be higher than you were at the beginning of the year. But 30% of those times, you're going to be lower.
That's right.
Now let's expand out to 5 years. If we go to 5 years in an index, then it's 93 to 95% of the time, your investment will be higher than what you put in. But there's still that 5 to 7% of the time.
There's a chance
that it's going to be lower. And those numbers are typically skewed when you include the Great Depression, the 1930s, and the post-dot-com bubble of 2000 to 2010, which most of the people listening to this experienced in real life. So there are times when that 5 to 10 year period can be negative, super rare. When you take that lens to 20 years, we don't have one,
knock on wood,
that's negative. Even 1929 to 1949 is positive. 2000 to 2020,
positive.
It's positive. So it's about time in, not timing.
If you're an investor.
Capital IF, if you're an investor.
And like I was saying earlier, it is the exact opposite. If you're a trader, you are actually trying to trade sometimes on the behavior of other investors.
People.
So
for every trade,
traders,
Louis, for every trade,
right?
If I'm buying, somebody is selling,
and that's what makes a market.
So the two of us are completely at odds with each other, regardless of the reason for why they're selling. They may have to pay tuition. They may be buying a boat. They may be buying a second home. They may have an option that they have to exercise due to a company grant. Like, it doesn't matter why they're selling. The only way they're selling is if somebody's on the other side buying, and conversely. So that's what's so interesting in terms of people. To your point, it's like you're trading against other humans. It looks like you're trading against your phone. It looks like you're trading against your computer.
And I feel like a lot of times it's looked at as almost you're just trading against that price.
Right.
You're trading against a price.
Right.
And the price is going down and you lost money, and so you're mad at the price. Or the price went up and you made money, so you're happy with the price.
You said something earlier I wanted to touch on. The other thing that makes trading incredibly hard and enticing for people is when you try to do it as a human, right? You're trying to click and buy and sell and analyze all this stuff. There are now algorithms
Yeah.
that are written to specifically scan news sources, social media sources,
earnings reports,
earnings report, and they're looking for keywords. And if they hear some Fed official say something about raising or lowering rates, that algorithm tells that portfolio to buy or sell immediately.
And there's been millions, probably billions of dollars spent on these algorithms and the wires to the algorithms and the distance from where the trades actually take place to make sure of one thing, and that one thing is that it is faster than you.
It is faster than you. And so when we hear people ask us about, oh, I'd like to be a day trader, I think to myself, make sure you get some good ulcer medicine and make sure you have a good psychologist to the extent, and I mean, we laugh about it, I mean, because we don't do this, but you almost need like a sports psychiatrist to be next to you, right? To like, because you're going to go through highs and lows. When it's a coin flip, you're going to have tough days, right? And you're going to have great days. Like you've got to. I don't have the stomach for it. I never have. I never will, and I just don't get it.
So all that to say, and again, we're coming at this from the lens of we are long-term investors. So we're totally biased toward that point of view.
Right. Don't hate mail us.
That's what we coach people to do. That's what we do. But really, and to bring back the saving portion, the most successful financial people of all time, Warren Buffett, that's who you immediately think of. They have a little bit of all three. They got a pile of cash to make them feel good and to make sure that they can go to sleep at night. That's what we call it, your sleep at night money. The money that in case of emergency is there, but it's not earmarked to be invested or to be traded or to even be spent on a regular expense. That is a pile that is sitting and waiting, and it makes you feel good. There's your savings. You're investing. That's your 401k. That's a joint account or maybe it's a 529 to send somebody to college. That's your long-term investments. And so there's your bucket too. But really on a kind of human level, especially in today's 24/7 news cycle, sometimes it's fun to buy something.
Right.
And that's why we personally encourage our clients to have outside investments.
Right.
And because we have a process that we work on and we're good at it, and that's what we do. And so if somebody calls asking about a trade, I don't know what to tell you because I'm going to be wrong because guess what? It's 50-50.
Well, and
the same way it is for you and me.
Yeah, and what I say in that situation is you just threw me in the worst possible scenario because if I tell you to go out and buy it, sure as I'm sitting here, it will go to zero.
Yep.
If I say don't buy it, it will double, triple. I have no idea. I mean, it is the ultimate catch-22 for the hey, what do you think?
Yeah.
But I do want to look at some misconceptions as we're near this, and just so the misconception on investing is that it is boring and slow. And the reality is that it can be incredibly rewarding.
Yeah.
So we always say it's simple, but it's not easy, right? So, but trading, the misconception there is like, oh, this is, my buddy bought XYZ and it's up 1,000% and he's getting rich and I want to get rich. So the thinking is that it's a way to get rich quick.
Yeah.
The reality is that it takes an incredible amount of skill, an incredible amount of time.
Yeah.
Like all day, every day.
And brain capacity.
And the part that nobody tells you, just like when you go to the track, nobody talks about their losers.
No.
So the guy that may have hit 1,000% didn't tell you about the 10 where he was down 100%. And guess what those two do, Louis? Offset.
So you're back to even.
So we're here to just give you what they are. Sounds like we're bashing on trading. If that's your thing, go for it.
Yeah.
Have
and there's
fun.
People who are great at it.
They are.
There are. But just not many of them.
Yeah, very, very few.
And they're usually not as great as they say they are.
I'll just leave it at that. So some practical advice.
Yeah.
So why don't you run through sort of the practical advice for normal investors that are looking to invest.
And again, this is coming from us who are investors with a long-term view. We encourage you to think about, what are my long-term goals and what is my time horizon, and focus on that and get educated on what that means. Read a book, talk to an advisor, talk to people who are older than you who've lived those experiences, and see how long-term investing has worked for them. Because if you stick to it, it works.
Yeah, and Louis mentioned it earlier, diversify, right? So this is not binary. You do not have, not all of your money has to be in the market or all of your money out of the market.
Yeah.
Put some in the market that you are comfortable with. Keep some out for unexpected expenses that are going to come up. The car breaks down, the HVAC blows up, whatever. That should not be in the market. That should be in a separate place. Rebalance,
please.
If you're young and you're coming into this and your sleep at night number is $1,000, like I need $1,000, I need to pay rent next month, so I'm going to always keep $2,000 in my wallet. Well, guess what? 10 years passes, you're married, you got kids. It should probably be more than that.
Yeah.
It should probably be like 2 or 3 months living expenses, and then you can invest the rest. And when you get even older, like somebody with gray hair that has to wear glasses to read, just as an example, thinking, out loud here, but that number should be significantly greater.
Yeah.
And that is okay. And Louis, what do we say? Like, what is the best way to succeed? You've got to be able to follow the plan that you've established.
You got to be able to follow the plan. And, that sleep at night number doesn't have to be a number. It can be a percentage.
It can be a percentage.
A lot of people will invest with the idea of, hey, I don't want 100% of my money in the market and at risk, but I think I'm good with 70% of it at risk. And so that means 30% of it is sitting on the sidelines. It is not invested in the market. But what happens when you see a year like 2023 followed by a year like 2024, where the market returns are incredible?
Right.
Your 70-30 portfolio has all of a sudden grown to like an 80-20 or a 90-10.
And you didn't invest any more capital.
You didn't invest any more capital. The market returns were great and you made money. But you should rebalance.
You need to think through whether you should rebalance, right?
Because you came in saying I'm good with 70% at risk, and now you got 90% at risk, even though it's a bigger number.
Right.
And so that's another kind of thought when you're rebalancing, and it goes with, hey, what is your plan, and are you sticking to it? And your plan isn't set in stone. It changes as you change, as the market changes, as your lifestyle circumstances change, whether you have a kid, whether you're married, you own a home. All these things happen throughout your life that change your plan, but you need to rebalance and reevaluate and make sure that you are on plan.
Right. So just to summarize here, obviously we are biased towards long-term investing and saving.
Yeah.
We are not good at trading, so we're not going to even pretend. But that doesn't mean, like, if you know what it is, like if you go in informed and you want to trade, hey, I always say we will be your biggest cheerleader if you are successful at trading. And so we wish you well. We just wish you wouldn't do it with us.
Thanks for listening.
This podcast is intended for informational and educational purposes only. It is not an offer to buy or sell or solicitation of an offer to buy or sell any security or investment or to participate in any particular trading or investment strategy. The information is considered to be from reliable sources, but its accuracy is not guaranteed. We do not offer legal or tax advice, so please consult your tax or legal professional for information specific to your situation. The opinions expressed are those of the speaker and not necessarily those of Robert W. Baird & Company Incorporated. Please note past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. You should carefully consider investment objectives and risks of any investment before investing. An investment cannot be made directly in an index. Securities and investment advisory services are offered by Robert W. Baird & Company Incorporated, a registered broker-dealer and investment advisor, member NYSE, FINRA, and SIPC. You should consider the investment objectives, risks, charges, and expenses of each money market fund carefully before investing. This and other information is found in the applicable prospectus for the money market fund. Contact your Baird financial advisor for a prospectus. Please read the prospectus carefully before investing. Money market funds are managed to maintain a stable $1 share price. An investment in a money market fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although the fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund.